Hey there, and welcome. You ever look at one of those financial charts and your eyes just glaze over? It looks like a chaotic mess of lines and bars, right? Well, today we're going to untangle all of that. We're going to break down the common tools traders use to actually make sense of the market. Okay, let's get into it.
Yeah, a chart like this can look, well, pretty nuts, but I want you to think of it differently. Hidden inside all those lines is a story about buyers and sellers, about fear and greed. And the trick, the real trick, is just learning how to read that story. And by the time we're done here, you are going to have the key to unlock it.
So what's our secret decoder ring for this? It's something called a technical indicator. It sounds complicated, but it's not. All it is a tool that takes all that past price and volume data, crunches the numbers, and gives us a simple visual. It helps us spot patterns and possibilities that would be totally invisible otherwise.
Okay, first things first. Before you do anything else, you need to know which way the wind is blowing. Is the market pushing up, sliding down, or just going sideways? For that, we need a compass. This is the absolute foundation of our entire toolkit.
Our compass is called the Simple Moving Average, or SMA. It's exactly what it sounds like. Imagine you take the closing price for, say, the last 50 days, and you average them out. That gives you one little dot. You do it again tomorrow, and the next day, and the next. And when you connect those dots, you get this beautiful, smooth line that cuts right through all the noisy day-to-day price swings and shows you the real underlying trend.
So how do you actually read the thing? This is the best part. It's incredibly simple. If that line is pointing up, the trend is up. If it's pointing down, well, you get it. Now, because it's using past data, it's always a little behind. It confirms a trend that's already underway. That's why traders get really interested when the actual price crosses over that line. It can be a powerful signal that the tide is turning.
And you can see it in action right here. Just look at that long run-up. The price bars are basically dancing on top of those smooth SMA lines, right? The lines are acting like a floor, like a form of support. But then look what happens when the trend starts to lose steam. The price punches right through those lines. It tells such a clear story visually.
But what if you need a compass that reacts a little bit faster? What if what happened yesterday is more important to you than what happened a month ago? Well, that's where the exponential moving average, or EMA, comes into play. It's the faster, more sensitive cousin of the SMA because its math gives more weight to the most recent prices. It's quicker on its feet, but that also means it can sometimes give you a few more head fakes in a choppy market.
This is a great way to think about it. The SMA is like the steady tortoise. It gives you that reliable, long-term view where every day in the period gets an equal vote. The EMA, that's the nimble hare. It zips around, reacting much faster to new information. And here's the key. One isn't better than the other. They just have different jobs and tell you different things about the market.
All right, so we've got our compass. We know our direction. But the next question is, how fast are we going? Are we cruising along with power, or is the engine about to stall out? Knowing the trend is one thing. Knowing the strength and speed behind that trend, that's a whole other level. For that, we need a speedometer.
Now, before we grab our speedometer, you have to get these two terms down. Overbought and oversold. The best analogy is a rubber band. If you stretch it way too far in one direction, what happens? It's going to snap back, right? That's overbought. Stretch it too far the other way, and the same thing happens. That's oversold.
And our speedometer for this is the Relative Strength Index, or RSI. It's what's known as an oscillator, which is just a fancy way of saying it bounces back and forth on a scale, in this case between 0 and 100. Its entire job is to measure how fast and how big the recent price changes have been, basically telling us if that rubber band is getting stretched too thin. The RSI gives us these really clear zones to watch. Generally, a reading about 70 is considered overbought, and a reading below 30 is oversold. But, and this is a really big but, this isn't a magic signal. In a super strong trend, something can stay overbought for a long time. So think of these levels less as a command to buy or sell, and more like an alert. A little alarm bell telling you to start paying very close attention.
This chart just shows it perfectly. Look at the lower window. That's the RSI line. See where it dives below that 30 level? Almost immediately after, the price gets a nice bounce. And then on the flip side, look at where it pokes its head above 70. Not long after, the price takes a breather and pulls back. It's an incredibly powerful visual clue.
So let's recap. We have our direction with the compass, we have our speed with the speedometer, but does the car have any gas in the tank? Because a price move without a lot of people participating is like a car just running on fumes. It's not going to go far. We need to check the fuel gauge. And in trading, the fuel is volume.
You know, the logic here is actually pretty intuitive. If prices are rising and more people are jumping in, that's high volume, that trend is healthy, it's got legs. But if prices are rising and fewer people are buying, that's declining volume, that trend might be getting exhausted. Volume is all about confirming the conviction behind a price move.
One of the classic tools for tracking this is the on-balance volume indicator, or OBV. Think of it like a simple running tally. If the price closes higher today than it did yesterday, it adds today's volume to the total score. If the price closes lower, it subtracts it. Over time, this creates a line that shows you whether the buyers or the sellers have been more aggressive.
Now with OBV, here's the secret sauce. The actual number doesn't matter at all. What matters is the direction of the line compared to the price. We're hunting for something called divergence. That's when the price and the indicator are telling two completely different stories. For example, if the price keeps pushing to new highs, but the OBV line is flat or even falling, that's a huge warning sign that the rally is running out of gas.
And here it is, a perfect real-world example. Look at the price chart on top. It makes a clear new high, no doubt about it. But then look at the OBV line right below it. It's actually sloping down, making a lower high. So the price went up, but the big money, the volume, wasn't following along. This divergence was a massive red flag that the trend was in serious trouble, right before that big price drop.
So there we have it. We've built our toolkit. We have our compass for trend, our speedometer for momentum, and our fuel gauge for volume. Now, the last step, and honestly the most important one, is understanding that these tools are way more powerful when you use them together.
And that brings us to the golden rule. No single indicator is a crystal ball. They just aren't. Think of them as clues in a detective story, not foregone conclusions. The smartest way to use them is to look for confirmation. Does your trend tool agree with your momentum tool? Does the volume, the fuel gauge, confirm the move? When all your tools point in the same direction, that's when you can have real confidence in what you're seeing.
We started with what looked like a chaotic mess, but we've turned it into a story. We've got a compass, a speedometer, and a fuel gauge. You now have the basic toolkit to stop guessing and start decoding the market's narrative for yourself. So the only question left is, what stories are you going to find?